Good morning, good morning, good morning, TGIF traders. Guys, do you hear me? Do you see my screen?
Hey, Kevin. Yes, everything is fine.
Okay, great. Thanks a lot. So, well, we've had a lot of expectations yesterday, and those expectations have not really been met, especially not for the dollar bulls, I would say. But okay, let's start with what we usually do, and it is going over the headlines that came out overnight. And there's actually not that much going on. There was a bit of a mixed bag on the Chinese liquidity front. Took some out, injected some others, but nothing really specific going on. So the industrial profits in China, where are they? You can see them. They show a -9% on the year to date, which is of course a very negative number. But if you take September, for instance, alone, that showed plus virtually 12% on the year and year. So we need to monitor those things, because that if the situation in China would start to change, then of course we'll have to perhaps change a little bit our view on what's happening to the Chinese yuan and the economic situation over there. Moving on to Japan. So first of all, the Japanese Chief Cabinet Secretary Matsuno came out saying that he expects the Bank of Japan to coordinate closely with the government on monetary policy to achieve 2%. That brings us all the way back to the start of Ueda's tenure. You know, I've been talking about this already a good number of times, that how they said at the beginning when Ueda took over as a governor of the Bank of Japan, that they would closely cooperate. And Matsuno is reiterating that, which brings me also back to what I said, that it is probably tying Ueda's hands a little bit to quickly change monetary policy over there. We have Bank of Japan out next Tuesday. We will, of course, preview that on Monday. There's been some expectations coming in that they could tweak YCC again. One of the other analysts said that it may even be the time now to get out of the zero interest rate policy. I would say it's not the base case that they are going to change anything, but they could be changing again their wording and saying that inflation could be stickier and higher for longer, because we saw this Tokyo CPI come out overnight as well. So that could force their hand a little bit in changing the rhetoric once more. But if it's going to impress the markets, I'm not so sure, because as we have seen over the past Bank of Japan meetings, there's always been a bit of speculation that they may do something, but they've clearly also be sending us to the end of the fiscal year again over there, which is in March, because they want to see the next round of wages. And talking about those wages, so Suzuki was on the wires again, the finance minister, and he, apart from his same warning that they are watching the effects with a sense of urgency, he did say that he still sees risk of falling back into deflation, and that the wage growth is outpaced by inflation right now. So there's a bit of a change in rhetoric that is said now. So if they think that there's a risk to fall back into deflation, that is already sending a wink to the Bank of Japan, saying that you don't have to be in a hurry to change anything. So it all muddles the outlook a little bit for what's to happen over the Bank of Japan, even in the medium term, right? So and it gives them the how shall I say, the excuse not to do too much on Tuesday either. So On the one hand, it takes away from the interest of the meeting, but we have seen over the past meetings that if the market is disappointed, it does not refrain from giving the yen another slap. So that is to come early next week. Yeah, there was a little bit of a report out that, of course, and let that not be a surprise, that the biggest exporters in Japan are now reaping the benefits from a weaker yen, because most of them were having their benchmark dollar yen rate around 125, 135, and they could add another $9 or so billion to their profits for this fiscal year. The thing is that if you take the exporters on the one hand, the importers are going to equally suffer from this. And since Japan is still importing a lot of energy, I happily dismiss this report. Last little one on Japan, and specifically on the yen, is that today we're having a lot of expiries around this 150, the figure. You have seen that we have really been pinned to this 150 until yesterday, where we tried to make a move for higher levels, but we've really been pinned around this 150 for quite a while. Let's hope that expiries today are the last big lump to be seen. I've looked at next week's expiries; it does seem to be less, but don't be surprised if in about 4.5 hours we are trading exactly at 150. Of course, in the meantime, we will have had all those PCE data to come out. Yeah, so they may change the picture a little bit. Closer to home, the ECB yesterday. You know, there's always, before I talk about the ECB and the US data, there's this always this piece about sources talking a couple of hours after the ECB release. Remember, the ECB did not talk about the PAPP, did not talk about the APP at all on yesterday's meeting. That was as much said by Lagarde, although the piece came out saying that they will probably talk about it this winter. So winter starts in December. Let's see if they talk about it. But that actually means, or could be understood, that they are not going to talk about it in their December meeting, because winter, in theory, starts only on the 21st of December, and by then their December meeting will already be done. And that, besides what she said or didn't say yesterday, is something that may weigh a little bit on those euro crosses. Now going over to staying in Europe, and we were supposed to have the releases of the October CPIs of the states in Germany next Monday. But Brandenburg found it interesting to come out with it already today, and that came in lower. Their CPI, their month-on-month, came in at flat, and the year-on-year coming in at 4.6% instead of the prior 5.6%. So that's a market slowdown there of the CPI numbers. I guess we can expect as much in the rest of the Länder in Germany next week, so that is one to keep an eye on come Monday. But it was interesting enough to mention it on today's flow. Then over to the American side of things. First of all, in Canada, and I found it interesting because, I mean, Canada has been plugged into oil lately, but at the same time keeping on the defensive. TD came out with a piece saying that they expect the Canadian house prices to fall as much as 5% during the end of this year and the Q1 of 2024. Before then, perhaps forcing the Bank of Canada to start to lower rates and then see this market move up again. But found it interesting that they are thinking that the house prices in Canada are continuing to fall over there. Right, that is it. Let's see what happened yesterday, or better said, what did not happen. So we had this a lot of hopes. Excuse me, just for 1 sec. So we had a lot of hopes built for this double whammy between the ECB and the data dump in the US. And then recall I showed you this the option straddle, the overnight straddle, what the option market was expecting, which was not a lot. And guess what? Once more, the option market makers were right, because the euro dollar, if you take the combination between both, should have seen the euro dollar move a lot, and that moved exactly within give and take a 50 points range, which is really, really not a lot if you see if you look at the importance of such an ECB meeting and then this mega data dump that we had out of the US. So as expected, the ECB left the interest rate unchanged. I told you one of the kickers may be that they start to talk about QT or the asset programs. Lagarde was clear enough to say they did not. She could have stopped her her press conference just by saying that they are data dependent, but she found it funny to spend an hour explaining data dependency and why, and especially trying very, very hard to explain why they are not. We cannot understand it as a full stop of the rate hike, but on the other hand, she gave us enough food for thought, saying about the risks to growth, etc. I stick my neck out and saying that we may have seen the top in the ECB yields. Yes, there might be this exceptional last one if inflation really flies up again, but I think it will really have to be forcing their hand to do another one. So you can timestamp me. I have been wrong in the past, but I think the ECB is done. Moving over to those data. So all those rumors flying around, you know that we spoke about that. The expectations, the expectations for the GDP started at around 2.5%. They went gradually up to 4.1, 4.5 was the last expectation of Bloomberg, and then Atlanta Fed came out with their nowcast the day before yesterday, saying it may print above 5%. And here we are at 4.9%. This is a really lofty number. And the durable goods were okay as well, even pretty good. And then we had this market reaction, which really was a non-reaction at all. We were trading quite close to the 5% in the US 10s, which is a big level, and it failed. And it failed. Why? So for couple of things. The market straight away, when looking at this number, the continuing claims, which are indeed showing a bit of a move higher. Let me put this closer, which shows indeed that we are moving higher again. So that was the first excuse to be taken by the market. Second one was that immediately afterwards, there were reports coming out saying like, okay, this 4.9% is a one-off. It's not going to be sustainable. Q4, people already, we are not even at the end of October, but people already saying that they expect Q4 to come in rather around 1%. So all of that was enough for, and the market was probably long dollars going into these data because of those very high expectations. So the result of it was actually the dollar being on the defensive. If you look at things, and we will going to have a look at the rates, at the FX rate very soon. But as a result of that, the dollar was actually on the defensive. So two things happened here. First of all, the dollar went on a defensive. If you see things like the cable, for instance, if you see things like the Aussie dollar, the Kiwi dollar, and even the dollar yen, it just came or rather down from levels where we are, and specifically emerging markets were all of a sudden turning around, where dollar mix was trading quite high, where the dollar rand was also trading well above 19, they came back down. So the second thing that happened is that the euro crosses started to be weighed down a little bit, selectively, but yet weighed down. And I think that the latter thing is relatively logic if one would agree that the ECB is rather done. And then if you look also at the fact that you are looking at still like a very, very high Q3 GDP number in the States versus the Eurozone, where if we get out of Q3 without a recession will be already something, but the growth will be contained to somewhere around half to max 1% in the Eurozone. Those are the expectations. So you're going to be looking at a very, very big growth gap between the both blocks. And you recall what I've been saying already a number of times. Inflation, you can trade it. Yes, of course, it's not completely gone, and we will trade inflation. Don't completely write it off. But what I've also been saying already a good number of times is that we should be looking now at the difference between growth in the different blocks in the different countries, and there we have to admit that the Eurozone is not in a great shape right now. And we just saw this morning the ECB survey coming out, professional survey coming out, and they are indeed expecting the inflation to stay a bit stubborn, slowly coming off from those lofty levels. But again, they have revised their growth forecast a bit lower. So where in the US you see higher growth forecasts, in the Eurozone you see lower growth forecasts, and the difference is quite big. That is it. Yellen came out later on saying that everything is rosy in the United States and that the higher yields are not her fault. It's not because the U.S. Treasury is issuing those pile of bonds that the yields are so high. Of course not. We've only been mentioning about 150 times. No. She says it's only due to the growth and growth differentials between the U.S. and the rest. She's not completely wrong, of course, but I don't know who she's trying to fool there, saying that it's not her fault that yields are at these levels. Okay, so that there's a lot of self-patting in the back there by the U.S. officials, saying that the economy is still strong, and they're right. They are right. But then the market is really looking at this one already. Next week. Remember, next week we have, as well as FOMC, we have the next labor report. Are we finally going to see that those numbers reflected in the labor report? Remember what I told you. It is one of the last big dominoes that is standing in the US. If that would start to fall, then we will have to revise our view on the dollar, I guess. But until then, personally, I'm having a lot of difficulties to outright sell the dollar to go short in the thing. And yeah, we had a bit of GDP data out here. This I think is a second reading of the Spanish GDP. Slightly better, but it's one of the outliers in the Eurozone. If you look at the German, French, whatever, they are not at those levels. Okay. For the data up to now, that's about it. We are going to have a bit of the Irish. I don't know if the Irish CPI is going to move stuff, but then this afternoon we will have the PCE coming out. Okay, and so that is probably going to be our next mover. Now, looking at those currencies, knowing that the dollar longs are not feeling that great after the combination of the ECB and those US data. They have the power to perhaps drive the dollar a little bit lower if this would really come out lower than expectations. We expect it to to gradually come lower. If we see a very low print, we may have a bit of a difficult day for the dollar to close the week. Now, if we hold there and the spending numbers are holding up, that should in turn then see us get into this value date. We're trading value date end of month with the usual possibility that US corporates have a bit of dollar shopping to do. So watch out what's going to happen after those numbers with the dollar into the 4 p.m. London fixing. So it could be a bit of an interesting one this afternoon, depending on those numbers. Prices are important, of course. That's what one of the things that the market is still looking at. But if they come out in line, I wouldn't go and really start trading a lot of dollars on the back of it. And the Michigan are the final data. Okay, so the Michigan are the final data. So they, unless we come out very far from expectations, they shouldn't be moving the needle too much. Just note that last time we had higher inflation expectations, but the main data were weak. So there was a bit of conflicting signals there on the Michigan data last time around. We are there. Okay. Grega, before I bring you in and we have a little chat about everything that's going on, I just want to show the people what I'm showing them usually. I hope you don't mind. I'm going to take very little time today, and then we'll have a look at everything that you're looking at right now. Okay.
Yeah, sure. No
Alrighty.
problem.
Okay, so traditionally, what I'm always looking at are the differentials here, and look what happened after the data yesterday. The differentials narrowed a little bit, and if you look at the cable, it's not especially or only because of this, but I've told you already, right? If you look at to explain a move, look no further, right? You had the disappointment that the US 10s couldn't keep it close to 5%. 30s came off as well, traded below 5%. They're a little bit above now again. And the 2s also came off a little bit. So the differentials narrowed. Look at where your cable is. It's trading higher than where it was going into the data. EU, US, and there you will see exactly what I mean too. Flatlining. We had a little bit of up and down, but flatlining. And where are we? We are merely 15 or so pips away from where we were going into the double whammy yesterday. ECB, US. Yes, euro is not going down on a rather dovish ECB and good numbers, but again, as I said, it looks as if the dollar went. The market went long dollars into those into the duet and is managing those around a little bit right now. Perhaps a little too long dollars, feeling a bit uncertain about what's happening. And then I'm just going to show quickly what I'm talking about in terms of the moves that we saw. So this is your pre US data and stuff move, and then gradually coming in there, the Aussie market also rejected those lows, and now we are trading quite a bit higher again. We're trading around just above levels where the CPI came out earlier in the week when we had that spike. I think if you start to tackle levels above 63.80, it's got to be a bit. The longs are going to feel the heat, in my opinion, and we could quickly see a move into the 64s. Kiwi did roughly the same thing. Kiwi is still trying to figure out what to do around the 68, 15, 20. We are trading above again, though, so that could be significant enough for the close of the week. After having tried well below, it's a pretty decent comeback as well. And then the last one I'm going to show you is the cable. We also tried to break there before going into the numbers. We went into the numbers around the 120.80 and then started to spike higher. We are again above this 121, 10.15, which was my nearest level I talked to you about. Okay, we are above there. If there's more short covering to do, this could move up to 121. I don't know, 70s or so. I tried to counter it yesterday around this zone, but I don't particularly fancy it. So I took a small negative on that, and that's about it. I'm still a bit short in this euro, although we could argue that there is room as well, and I'm taking that into account, room to go up around the 105.80s. Why not 106, right around there? But I think the ECB was dovish enough to keep euro dollar contained. Perhaps I should flip into a kind of a cross also, but that is something that I will have a look at later today. Last one for the road, and then Grega takes over. Dollar CAD, we are holding above the support zone here, which is 75.90. I'm going to say also still just above the prior high. Oils have been whipping around a little bit, but the Canadian dollar is hardly finding too much of a bid. And also, if you look at the cross side, Canadian dollar is actually a little weak right now. For as long as this holds, I think there's still a possibility we are going to have a look at the 138.5, and then dollar Swiss is also still supported by the cloud activity. We are trading around the 200 DMA, so that's going to be important enough for the close of the week. Now, without further delay, I give the hand to our headmaster surfer of the Elliot Waves, Grega Horvat. Grega, please take it away. What are you going to talk to us about today?
Well, I will walk you through a lot of charts actually. Firstly, I want to start with just a second, with the US Treasuries. Just a second. Okay, and then I will do the connection with the US dollar and so on. Okay. So, as you know, we are still in quite extreme positioning here. But I think that we have to realize that maybe this move, it's a little bit overextended. And I think that based on this rates expectation and so on for the next year, that we could really see a turnaround here. And also, if we look at positioning, it's definitely that these institutions are heavily short. So I think that maybe since we are reaching the same extremes like back in 2018, that maybe we really are at the late stages of these current cycles. Not to mention that we have clear 5 waves down, and we know that whenever market moves in 5 waves, this trend can slow down. So I think that this bounce.
Yeah. Can I straight away ask you a question on those data that you just showed? What's the latest? What's the last update there? Is that last Friday?
Yeah.
Okay, so last Friday includes the Tuesday of that week, right? And that's it.
Yeah.
Okay. So because I'm thinking about the stuff that Bill Ackman said on Monday, which sent the yields lower and the notes higher. Those. If people like them changed from Monday, Tuesday this week, those data should be included in tonight's report, right?
Yeah, exactly.
Okay.
On Friday is updated, yes. But I think that on the bar chart where I have it, it's a little bit delayed. So the latest data, as I see, it's from October 23rd. Let me see if I can.
No, the data are from October 24th, but I think they only go until the Tuesday of that week, no? Or okay, never mind. I was just wondering if those Monday, Tuesday data of this week were going to be included in the picture.
No, I think that this is from the last week. So
okay.
The latest data from the COT will be updated on the page I gave you also in the chat box, should be updated during this weekend.
Mm-hmm. Okay.
Okay. Yeah. But still, I don't believe that we will see any kind of a change here. So the idea is that we are at extreme levels, positioning here on the short side. So based on the sentiment, I just assume that we could be seeing a reversal in this trend. And also, as I said, because of those 5 waves down. At the same time, I still think that dollar index is only in a temporary recovery here, and that we are moving into the strong potential resistance zone up here. Also, the US yield, as you know, is trading at new highs around 5%. So I'm not really sure what should happen with the US yields if this correlation will stay intact. So if US yields goes to 8%, then maybe dollar index could really retest these highs. Or in the other hand, if we have some really breakdown on financial markets, then obviously that's also possible. But I think that the US yields will potentially stabilize now here around 5%, potentially even move lower next year, and this could cause lower swing high here on the dollar index. So I think that this 50% retracement, 61.8%, around 108, 109, it's a very big potential resistance. But for now, the trend is still obviously here. So if we are looking at this as a traders, then definitely maybe you want to be looking for opportunities on the upside still. From Elliot Wave perspective, the latest drop here has also been in 3 waves. So as I said, 108 maybe could be in the cards for next week. We have a nice broken flag pattern here, or this corrective channel has been taken out. So I think that after the current temporary setback, as I said also earlier, we haven't seen any real volatility since yesterday. It was just widely or too much expected and nothing happened. So maybe the market will slow down into the close. We have also some holidays next week as well. So maybe some slow price action could kick in, but I really think that if we go towards 106, 106.30, there can be opportunity on the long side. So I'm still a fan of the dollar longs as long as we are holding this 105.36. If we break this level, then I think that we have to turn a little bit more bearish.
The thing, if I may, on that one, okay, I must say I'm not a dollar index fan, but if you overlay that with euro dollar, which is the closest one that you can with, that's going to bring us very, very, very close to big targets where we're looking at somewhere in the 102, 103 zone, right? If we would get such a move over the next couple of weeks, and I've been talking about that as well on the Flow Show, and even on Face, which would be an area where I really would start to look to see, perhaps not even in euro dollar, but equivalent in other currencies also to start to counter trade dollars, because it's I mean at that time it will be, even in my fundamental, like only looking from fundamentals, it will likely be enough. Let's put it that way.
Yeah, I think I'm looking for big levels like 103.
Yeah.
So expecting the final push to the downside. Also, maybe we get some recovery on stocks going into the end of the year.
Yeah.
And this could potentially change some trends here. So I'm also looking for this to be only a temporary pullback. I have this basic chart here. You can see that we have 5 waves up and then a 3-wave countertrend movement. And we are actually now in wave C position. Here's a part of a flat correction. So we are, I think, approaching to some very interesting levels. But as I said, in the short term, looks like that there can be still a little bit of more weakness. We also stopped here on this recent bounce at this previous swing low, right? Here around 107, it was a very big important resistance. Also, it's the 50-period moving average as well. So I think that for now, still, we are bearish, but maybe another final low is coming, and 103, 104, I think, could be very interesting support. So because the euro is very weak, I think that you said yesterday also on Face that those crosses, some could be very interesting play because of differentials between central banks. I mean, in Australia, as you know, because of inflation, the RBA is much more hawkish than the ECB. So I think that this could provide us some opportunities on crosses as well. So I'm looking at the Euro Aussie for potential push to the downside, where I have it here.
And while you're looking it up, if you look at it from that angle, yes, and if you also would look at it from and it would also coincide very well with stuff like if you think that there is not going to be a lot of stress on financial liquidity, for instance, over the end of the year, and you would see the equity markets recover, that is also going to impact process like this, for instance, because as I've already told the guys on and the girls on this show as well, Euro and Aussie, you can turn it like you want, but they are also part of a risk play somewhere. If the market really goes risk off quite a bit, you tend to see those Euro crosses go up versus the most fragile currencies. And the opposite is true. If there's less stress in the market, you would see those kind of Euro crosses actually come off.
Yeah, exactly. I absolutely agree. So those commodity currencies, definitely, if there are stocks that in risk on mode, commodity currencies are much more attractive. So here I'm also looking for potential top formation. We are just testing this channel here. So I think that was the recent corrective rise. It could be temporary, and I'm just waiting on this trendline support maybe to be broken. Maybe already next week, we also see something similar, if not even better, on Pound Aussie. There I'm looking for this head and shoulders top formation, okay? So here we have left shoulder, top, and now the right shoulder. So I think that maybe we are already trying to complete this current right shoulder. If we today, let's say that Aussie will stay strong, and we see maybe here on Pound Aussie, we see a break below 1.9 level, then I think that weakness could already send us much lower next week. So in general, I really love how Australian dollar is moving across the board. I also see even Aussie dollar making some very interesting bounce, despite being euro and cable quite weak. Australian dollar has seen a quite nice rebound here from that recent lows. And even if you're looking maybe at this price chart from a basic technical perspective, and you ignore these wave labelings, you can still see that somehow the price action here, okay, from the last few weeks is really struggling. Yes, we are seeing new lows here, but bears are losing some momentum here. So in my opinion, this kind of a price action, okay, occurs at the end of the trend. So I'm really prepared on a potential reversals here. And I would be looking for, even for some longs next week, if we see, let's say maybe today on Friday, that somehow we see some rally on stocks after those losses recently, and we managed to close on Aussie here somewhere above this or around that trend line, then I think that there can be opportunity actually on the long side here. So if I will decide maybe next week that I want to be dollar short, then I would leave euro and or cable on the side, and I will focus on Aussie. If I want to be long dollar, definitely euro dollar is my first choice to be selling it. Okay, so that's for Aussie. Let me check some of my notes here. Also, of course, we should maybe pay attention next week to metals. I still think that metals are doing very well, and we have seen some gold that was outperforming quite big compared to silver, right? But whenever looking at this gold silver ratio, we can actually see that price is now trading at the upper side of this contracting range. So as you know, normally when metals are in a new bull run, you can expect that gold silver ratio will move to the downside. So I assume that there is much more upside potential on both gold and silver, but maybe the silver can be a better choice because it's also having a very nice potential head and shoulders formation here. Firstly, that's the monthly chart. Okay, so that's the left shoulder head and the right shoulder. And we recently noticed that this right shoulder was quite similar to the left shoulder. And by the way, we have a very nice monthly candlestick so far. So I think that we can see more upside. Also, we have a smaller head and shoulders pattern as well, building up here on the 4-hour time frame. Okay, so that's your left shoulder, head, and now the right shoulder. What I also like is that despite this very strong drop here through this triple bottom, we have seen a massive break below 2220, but then immediately reverse back to the upside. So this clear tells me that bulls are taking the control here.
Yeah, and we even have a retest in the of that red line in the one just before, the one just before on the 16th. There on the 16th, just above. Yeah, there we even have like a retest of the red line if you continue the.
So generally speaking, I really love silver. We still know that geopolitical tensions are here and likely to stay. The markets will be a little bit tricky. So I think that metals could do very, very well. And I really love how silver is doing. And I will stick to this bullish view and look for potential longs next week. So $22, maybe $22.20. That's, in my opinion, very attractive support. And we'll be looking for more gains while we are trading here above 20.70. Also, I'm not sure if you talked about dollar Swiss franc. So it looks like the Swiss franc can be also attractive, as you know, as a safe haven in this economic uncertainty. So I think that also Swiss franc, check here. Okay, so here I have, it's actually gold, silver compared to Swiss franc. We know that correlation is pretty strong. Okay, so that's actually dollar Swiss compared to silver. Okay, but if I do and reverse the scale of silver, you can see that the correlation is very strong, right? So I think that if silver metals will see more upside, Swiss franc will also strengthen, and or if you want, dollar Swiss could come down under pressure. So here I'm looking, and we'll observe the levels after this broken trend line for next week. Here it's a very nice, beautiful resistance around 90.50 up to 990. Around there we have the 50 and 61.8% fips. So in that area, I think that we could see another maybe final push to the downside, but I really assume that if metals will stay in uptrend, that dollar Swiss franc will see deeper corrective pullback here away from that October highs. Also,
it's funny because I'm actually looking at it completely the other way around. We are supported right now, but it's just like a play that I have like on. I'm going to explain also why. So first of all, I think
inflation.
Sorry?
Because of inflation, maybe.
No, because of the fact that the market is very much suffering from collective Alzheimer all the time. And if you look at how oil reacted, for instance, around $90, and even though the Middle East stress, the geopolitical stress is still there, you can't hold those highs. And then if the Swiss has been really supported by geopolitical stress as well. Yeah. But on the other hand, if you look at the Swiss interest rates are still very, very low. And then Euro Swiss has printed near new lows, but is holding as well. And then if you move on to the more picture side of it, if you move on to the daily, there's a daily Ishimoku cloud is supporting dollar Swiss right now. There was also some support on the daily dollar Swiss around 89, 90, 89, 88, 90 and stuff. And I'm actually playing it on the other side from that level below. The thing is though on the daily that we're struggling here around the 200 DMA, which is 90.06. I'm not a big fan of moving averages normally, but
we are turning
around there, right? So I would like to see a close above there to go and have a look. And but your resistance, that is one that I'm going to respect as well, because if we get up to, man, let me kill my squawk. If we get up to that 90, 91 zone, I think that would be enough. And then if you even look at the global dollar picture, that may be enough, you know, up there.
Yeah, sure. So we will see. How much is inflation in Switzerland?
They're back below their 2%.
Yeah,
I think they're 1.8 or 1.7 or so, the latest.
Yeah, that should be also one of the main drivers.
Yeah.
For this pair as well. So
yeah, because I think that actually S&P is done hiking rates as well. But
yeah.
Yeah. Alrighty.
Okay. Let me just maybe for the end.
Yeah, that's an interesting one because we are on levels, right, in the S&P.
So the S&P 500, I'm just looking at the big picture, maybe some here. I'm just afraid that we will stick and remain stuck in this range for a while, just because everything, as you know, what is going on. I'm not really sure how investors will be pulled into this market to buy it. I just assume that we could remain stuck in this range for some time. Maybe this could be some kind of a triangle here, but there will be some recovery potentially, not maybe some relief rally. I'm looking for this wedge now, currently testing the lower trend line support. So as I said earlier, if we can rally and maybe even higher somewhere well away from that wedge support line, then I think that maybe some relief rally would come in play, and that's when my focus would probably next week turn towards Aussie longs, as I said. If we will see more weakness here and finish even on the weekly basis, and by the way, it's also end of the month, at the lows, then I think that dollar strength will resume, and my first choice will be shorts on euro dollar on the pullbacks.
Okay.
Yeah.
All right.
Okay.
Is that it? Thank you very much, Grega, for joining me today. Makes me feel less lonely, and of course, we always appreciate your input as a headmaster surfer of the waves. If you wanna hear more from Grega, he's regularly on the Face Show, got his own X page as well, and doing a lot of stuff on the site. And well, trade safely for the rest of this week. Have a wonderful weekend. Take good care of the ones that are dear to you. And we speak to each other again next week. Thanks again, Grega.
Thank you. Enjoy, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.